if your home is called 5 miles from the school, it's at a higher risk of being redistricted out than a home that's a mile from the school. Closer you are, the harder it is to like somehow finagle it into a different zip code. The closer we are to the school, the safer we are, and also the closer we are to the schools, the better odds we have of the home renting faster.
Welcome to the Path to Passive podcast, where we talk about building wealth and empowering lifestyle through commercial real estate investing for tech professionals. I always wish that other tech professionals reaching financial freedom had documented their journey along the way, so I'm doing it for the rest of us. Join us as we explore stories, many failures, and lessons learned along the way. I hope you enjoy and subscribe. Sean, man, good to have you on the show. Appreciate you being here. This is kind of a niche one. I haven't come across this type of asset, so I think it's really cool given your background as well that we're gonna dive into. I think this is pretty neat, and I'd love to break this down for the listeners for what you and your company invest in. And so, tell us a little about who you are, your background, and feel free to go a little more, not just what you're currently building right now, but where you came from. I think it'd add a lot of texture to who you are too, and then we'll dive in a little bit into business model.
Yeah, for sure. Appreciate being here. And yeah, happy to talk through from a background perspective and what we're up to at Scholastic. So at its core, I'm originally from the Chicago area, and I moved every single year of my life growing up, which was quite a bit. So I moved 22 times before I went off to college, and My mom was a teacher in that process. So I was pretty tuned into like school districts and, hey, we've moved 22 times everywhere we live, no matter where it is, across the country, internationally. There's always a really good school district nearby. People tend to really care about it. It's a universal human thing. If you've got kids, you tend to think about the best school district. So it was kind of an interesting observation that I didn't really know what to do with. And then from a school's perspective, so I went to Wharton undergrads program, graduated, worked in consulting for BCG, started doing a lot of private equity diligence work, and starting to think about putting together investment theses. How do you make decisions on what to invest in? And at its core, a lot of it really came down to supply and demand. And I started thinking back to what I learned from moving so much, and was like, hey, homes in really good school districts, there's a lot of demand to be there because it's a home in a great school district. If you look at it on the supply side, really good school districts tend to not have land available because it's a good school district. Every plot of land that could have a house already has a house. Number two, those houses are almost always owner occupied, meaning there's not rentals available. And then number three, these areas tend to not allow multifamily development. So you put all that together, supply on the rental side is really tightly constrained. If you've got that supply demand imbalance, like you can do something with that. So I started buying homes in good school districts under that thesis while I was working at BCG. And then fast forward 5-6 years, got to the point where it was like, okay, like I think there's enough meat on the bone here. I think it's time to build a fund specifically around this concept of homes in good school districts.
Cool. Yeah, that's what I was going to ask, because the question that is a common question, but the answers are so widely different, which is like, how did you get into real estate, right? And it's kind of the fun origin story where you get to kind of mix in your unique experience, which is moving that 22 times. And so kind of looking backwards, I would imagine, right? Of what are the things that are kind of crazy about my life that I can leverage into something too, right? And so was it just at BCG you're thinking, okay, like many people, like what do I do for investments? And then how did you mix in? How did you make that realization of, well, I moved this many times and I become really good with looking at markets, right? Too. How did you leverage? How did you get that realization of moving all that to moving forward with investing?
Yeah. So for me, real estate's always been something I've been really interested in because of them moving so much. Like I got my license at 18. I never actually did anything with it, but just for fun, because I wanted to learn more about it. I took a lot of real estate classes while I was at Wharton as well. What I didn't know was, I mean, real estate's a multi-trillion-dollar asset class. There's a lot of different cuts and flavors to it. So I always knew I was going to be putting money into real estate at some point. I just didn't know what cross-section of asset class, class of asset, tenant type, location, intersection was the right fit for me. And it was really the BCG experience that allowed me to kind of think about it from a like first order principles perspective of like, hey, like how do I think about buying something in real estate that fits under the experience I saw of that supply demand imbalance.
Okay, cool, man. So tell me a little bit more then about how you go and look at markets. You talked a little bit about that already. It makes sense. Around the school, usually owner occupied. These are
Mm-hmm.
probably homes that have and people, families really that have been there for a long time too. Oftentimes, many generations built around the school. But what
Mm-hmm.
else do you look at to look at what the good markets look like for this asset class? Single family homes primarily, right?
Yep, single family homes. And for us, there's kind of two different cuts to it. One is like what markets and zip codes are we going to be in, and then which homes within those zip codes. On the zip code selection of like, hey, where do we want to buy these homes? There's a bunch of different things that go back to that supply demand element. So on the supply side, like we've got minimum owner occupancy percentages. We've got number of building permits that has been issued in the past couple of years to make sure that there's not a lot of building going on. And then on the demand side, there's a bunch of specific things that we're looking for from a school district perspective. We look at the great school scores, for example, because that's what's integrated on Zillow. So people are looking at like it
Mm,
has to be good, but also other more opaque things. Like we have a data set that shows what percent of the high school graduates go to, I think it's Harvard, MIT, and Stanford. And there's a
mm.
certain percentage we want to see in that data where it's above that percent. Um, but there's a lot of zip codes across the entire country that fit that specific all those details like Highland Park, Dallas, Pinecrest, Miami, like Palo Alto, California, like those places fit. What was actually the most critical step for us is we're building this portfolio to sell. Like we're building it in a way where we can sell it to Invitation Homes or Progress or Tricon or Blackstone, which is I guess now the same entity. But like we're building it to sell. So we spent time on the phone with everyone that we possibly could at those funds. Some of our board is from those funds and said, hey, if we try to bring you this portfolio in a
Mhm.
decade and try to sell it to you, where do you want it to be? And the unanimous answer they all came back to us independently was Upper Midwest is where we will be most excited to buy this portfolio from you. So we said, great, we're going to look for those good school districts that are in Minnesota, Wisconsin, Illinois, Indiana, and Michigan. So that's all of that taken together. Those states from those funds, plus the data that we were actually looking at on the zip code level, got us to a list of 37 zip codes that we look to buy homes in.
Very cool. And you're talking about high schools specifically that are feeders into those other schools too, right? So primarily around high schools?
Yeah, so we care about high school is kind of the leading indicator, but we look at high school, elementary, and middle school. High school is the leading indicator because at least what we've seen in the data, if a area has a really good high school, the middle school and elementary school tend to be really good too. But the inverse is not always true. Where like you could have a really good elementary school, but the high school is terrible.
Mm, okay, got it. So if that's the case then, and the story and the picture is becoming a lot clearer as you're saying this, whoever's listening on this too is so tell me about then you're really looking at the parents as the ones, and so tell me a little bit about the tenant pools then, if these you're buying and you're looking to rent them out too, right?
Mhm. Yep. We have a really unique tenant pool, and I haven't come across anybody that's got a similar one to us. So our average tenant makes $228,000 a year. All right, the two most common jobs our tenants have are software engineer and doctor. So it's a pretty well established family. It's a family that could buy if they want to, but instead are choosing to rent most of the time. And it's a pretty interesting and specific timeline and niche that we see. Most of the time, our tenants are moving in when their eldest child is 14, basically when they're about to start high school. And the family already lives close by most of the time and is basically upgrading school districts for high school because they want their kids to go to good high school and then go off to a good college. Software engineer doctors, their families that tend to prioritize education. They had good educations themselves. So they go, okay, I'm gonna move to this area because I really want my kids to get their diploma from the
Yep.
school. The implication that comes out from that, though, is tenants are moving in and they're planning on staying a minimum of 4 years. Or if
Mm,
they've got multiple kids, it's 6 years, 7 years. So we're signing multi-year leases up front with tenants with annual rent escalators in them. And on the tenant side, most of the time, because it's a doctor, it's a software engineer, they're doing the buy versus rent math. And they go, hey, I'm only going to be here 4 years. Buy versus rent, 4 years, it is almost always cheaper to rent.
Yep.
So they do that math. They rent for 4 years. Their kids go off to college. And then we see a lot of tenants move to Florida. It's like, all right, like empty nesters, like I'm going somewhere warm. And then that's that.
Yeah, definitely. So are you really then just for each of the assets at least is the the part of the thesis too, and however many cycles that ends up being over the next 10 years if if your tenant is 2.5 times rolled over or turnover from whenever the
Mhm.
sell of the fund date is, right, the exit plan. But is it that you just get in someone new, a new family that comes in with that quote unquote maybe 13 or 14-year-old again to repeat the process?
Most likely. We do see other tenant profiles, but that's our most common one. And that's most likely the way that we expect this to go is family comes in, they get their diplomas, whatever it might be, depending on the number of kids.
Hmm.
And then they no longer need to pay a premium rent. And they go to Florida, and then we bring in a new family who's excited for their kids to go to high school.
Are you marketing Florida to them at the very end of the cycle?
We no specific marketing on our end, but it's a pretty uncanny pattern how much we hear Florida come up from soon to be empty nesters.
Got it. I see you in your next business after you make your exit plan for the fund. Cool. So, that in mind, I mean, like you're talking about, there's a lot of zip codes. So there's a
Mhm.
lot of opportunity as far as total addressable market, as well. What does acquisition strategy look like? I mean, obviously, pull zip codes, criteria. What is this normally like? Three twos, 3 bedroom, 2 bath types of things.
Yeah, we average 3 to 1,700 square feet.
Okay, gotcha. And these aren't where your primary channels to do acquisitions? Is it like direct? Like where how are you getting your acquisitions?
Yeah, most of the time for us is actually MLS. So we've built custom software. It's actually retool based with a ton of APIs on it.
Mm,
But at its core is we look at what's on the MLS and we can filter through. Typically, on any given day, it's between 1.4 to 1.8% of the homes that are on the market on the MLS fit our acquisition criteria. And then at that point, it's just can we get it at a price where the unlevered yield on cost makes sense for us to do so. What works in our favor on the acquisition side is two things. The first is because we're buying in high owner occupancy areas, we are the only investment buyer coming in, which means when we call the agent's eyes light up and they go, great, I get to double end this commission. I'm going to make double. These guys are not going to nickel dime me on inspections. I don't have to worry about the mortgage getting accepted. Our offer acceptance rate is 55.1% right now. And
nice.
it's almost entirely because of the agents going like, hey, this is going to be a really good deal for me.
Yep.
And then the second thing from that is because it's only 37 zip codes and real estate is such like a 90-10 game where there's like a couple agents per zip code that control everything.
Hmm.
37 zip codes, like 2, 3 agents a pop, like there's 75 agents or so that we're going to buy 80% of the homes from. We're now at the point where they sign a listing and they give us a call and they're like, hey, I got a home coming next week. I think it's going to be a good fit for you. Like, do you want it or not? Which gives us a pretty good kind of overlay. That's the majority of it kind of from the jump. We do a couple of different things. On top of that, the first is the majority of sellers are people who are empty nesters themselves. They no longer want the property taxes of the good school district. Because these are all good school districts, the high schools publish a list of where their high school graduates are going off to college next year in April. Like that's your target list of who everyone who's going to be selling
Yep.
in the next couple of months. And then the other thing that we do is we have a partnership with another fund now where we can do 721 exchanges where landlords who are tired of being landlords can basically invest their homes into the fund and avoid capital gains taxes in the process. Most of the time, everyone's situation is different. But we're increasingly going down the 721 path as well to pick up homes in the areas.
Can you we don't have to get into the specifics, but just the high level one or two liner strategy on what the 721 is.
For sure. The 721 is basically like a 1031 exchange. At its practice, we can take investment from folks in cash, or if somebody has a house that we want, they can give us that house, and we can give them LP interest in equivalent to the amount of the house. So they give us $1 million house, we give them $1 million worth of LP shares. That's incredibly attractive for most folks because they don't have to pay capital gains on the sale of that home. And they basically are going from active landlord to passive LP in that process.
Yeah, what a cool offer. that that is probably so out of the box for many people. That's not even, talk about level of creative financing, right?
Yeah, it's funny because like I got a call earlier today from somebody who wanted to sell us a home, and I told him about the 721, and he's like, that's a no brainer. It's like yeah, like you're gonna save in his case like 200 grand of capital gains taxes, and he doesn't actually care. He doesn't actually want to sell because he wants the money and cash. He wants to sell because he doesn't want to be a landlord anymore. It's like
Hmm.
he doesn't have to be, and he's going to save the capital gains.
Yeah, that's outstanding, man. That's super cool. Well, the reason why I was talking about, out of curiosity on this is,
Mm-hmm.
you have that many zip codes, and of course the 90/10.
Mm-hmm.
The few that control the many. Um,
Yeah.
uh, and so your deal flow is pretty great. Obviously, these are zip codes, so I mean, I know each one's different. Zip codes vary based on the municipality, all that. But I'm thinking, from a scalability perspective, like I guess there are you. It doesn't sound like you'd be too concerned about you owning too many, um, and saturating around a particular high school. Then,
It's a good question. We do think there probably is a point of saturation. We just don't know exactly where it is. Our average town has got about 6,000 houses in it.
there you
So
go.
if we own like if we own 60, for example, like it's still a really small percentage, and then 60 homes across like 40 zip codes, like we're at 2,000 plus houses, and we're $1 billion fund at that point.
Yep.
So it's there probably is a point of saturation, but we think we've got enough zip codes and enough homes in those zip codes where we can get to a really nice size scale and on a financial outcome for our investors without getting to a point of total saturation.
Yeah. Because around universities, it's going to be the opposite. You're going to have more
Yeah.
multifamily student housing, and you're going to have, exactly. Okay. Yeah, it's kind of interesting, point on that. So, like, what risk factors do you perceive then? If you're really yeah, I'll leave it at that. What risk factors do you see?
There's a couple of them. A big one is redistricting. Like if our home is valuable because it's in a good school district and they redraw the maps, and we're no
Hmm.
longer in a good school district, like that would be a huge problem. So we go in areas that don't that have never done redistricting because like that's a big risk.
Yeah.
Um, the other two other big ones. One is school decline. Like if a school gets less desirable, like that
Yep.
hurts us. We're looking for areas that have been really good for 50 plus years. I really don't want to be in the like fast rising school district because that can go back down just as
Hmm.
quickly. And then the last piece is regulation. I mean, there's a lot of talk about single family funds not
Hmm.
being great fits for the country as a whole. And there are certainly some funds that do some stuff that is relatively shady. Um, we think we're on the right side of the debate there. I mean, we have tenants and break down in tears when we tell them that they get accepted for our place because some of our zip codes, the median purchase price is over $1 million. Like if you want to send your kids to that school district, $1 million house, that's $250,000 down payment. Like it's a lot more affordable and a lot more accessible to pay 3,500 bucks a month in rent than it is to save up 250 grand for most Americans. So like we think we're on the like accessibility side of that
Hmm.
equation, but that's our interpretation, and others are welcome to their own interpretation of that.
Yeah, it's a good point. It's definitely a good point. Like you're talking about doing the math, not only. Uh, I mean, there's so many things to be said there. One of which, very much so, is that it's like, what is where is society going, right? And how do they act really? I mean, there's that whole argument about wanting to do build to rents as an asset class
Mhm.
because this is how people want to do things. But in this case, you're serving a completely different market and you're aiding them as well. Um, okay, so how do you hedge against that from the redistricting? Because just because they haven't 50 years doesn't mean they won't in 5 or 10. Is that building relationships with like local councils and things like that?
So there's a couple of different things. What two things really. The first is when we select zip codes, we're looking for areas that are, um, for lack of better words, like willing to fight policies that they don't like.
Hmm.
For example, like in most of our areas, there have been very big fights to block and prevent multifamily development from happening.
Sure.
Um, we would expect similar things if like a redistricting happens, because our property values would go down, but also a lot of other people's property values, and areas that have historically put up big fights about changes or perceived changes to their property value from multifamily, which transparently doesn't really affect their property values anyways.
Hmm.
We think are like leading indicators of like what would happen if the council tried to do that, and then the implications that come out from it. The other thing is, uh, redistricting. If your home is called 5 miles from the school, it's at a higher risk of being redistricted out than a home that's a mile from the school. Closer you are, the harder it is to like somehow finagle it into a different zip code.
Absolutely.
Um, the closer we are to the school, the safer we are,
Right.
and also, the closer we are to the schools, the better odds we have of the home renting faster. Like families walking the kids to school, like that's a really awesome thing. I've had kids myself. Like I love the idea of walking my kids to school. um, if we're close to the school, like the homes rent faster too.
Yeah. I mean, that's what I was thinking because on a risk matrix, the further out and the least less desirable. And just like you were pointing out, not only is it gonna rent quicker if it's closer, but there's less risk at being part of that rezone, potential rezone. And
Yeah.
ironically, there's quality of life aspects, the intangibles are so much nicer too.
Hmm. Well said.
So how did you test this? Like, where'd you guys get the first one from? I mean, on paper, it makes a ton of sense, but where was it like, let's do it here first? You know?
Yeah. So my wife and I lived in Chicago at the time. So we decided we would pick a zip code in the Chicago area, like within driving distance, because I wanted to self-manage it. I wanted to do every single tour with prospective tenants. I wanted to talk to them. I wanted to learn from them. Like everything we talked about, like our tenant demographics, like the age the kids are moving in. Like we didn't
Hmm.
know that at the beginning. We just thought like good school districts is probably going to attract people who want to live here.
Yeah.
So we picked a zip code in the Chicago area that we could drive to, so I could do those tenant tours. And I mean, was fortunate. Like I had a very good income working at BCG. My
Hmm.
wife also was working at BCG. It's where we met,
Nice.
and we didn't have kids at the time, so we were a high earning household. So it basically allowed
Hmm.
us to start buying a pretty significant number of homes in a couple year period, in our early 20s, basically
Hmm.
to start and test the proof of the thesis. And we did that for years, and multiple tenants, multiple houses before we said like, hey, I think there's enough here that it's time to think fund.
Got it. And I'm always curious from like a vision perspective. Is it,
Yeah.
obviously that makes sense. Going and doing everything first, getting to know really your customer. You didn't know a lot of those problems until that your tenants were going to have until you started showing more, getting to know people, and really
Mhm.
it's kind of consulting 101, right?
It is.
uh, and so was there was this were you thinking of, well, we have this challenge, why won't we just solve this for other people as well? Or was it just kind of, let's get into um start buying investment homes and this could be an opportunity and great market, and then you scaled from there?
It was initially, the thought process initially was like, we're just going to do this with our own money and invest with our own money.
Yeah.
I had no illusions and like dreams of grandeur of building a fund or anything like that. It wasn't kind of an intentional process.
Hmm.
Um, the fund actually almost happened more by happenstance as we were growing and going along. I started having people reach out and say like, "Hey, next time you buy one, it seems like this is going great. Like the thesis makes a ton of sense to me. Like, can I kick some money in to the next one?" And that kept on happening to the point of like, hey, well, I'm starting to do the math now. I was like, okay, like we can buy more homes with this. And hey, if I'm doing the math here, like I think our cost to repair per home per month is going to go down because we're now going to have more purchasing power with our vendors. Like I can guarantee our HVAC guy a specific amount of volume. Like our
Hmm.
prices are going to go down. It's like, oh wow, our insurance is going to go down 30% at this point. And the collective power of a larger portfolio was pretty apparent. It was like, if I'm going to take on any dollars from anybody else, I don't want to do it in a way that's going to do like an outcome. Like if I'm going to do this, I'm going to do it right.
Hmm.
So if I'm going to bring on outside dollars, I'm going to bring on enough that we can get that pricing power. We can get the lower insurance. We can build a portfolio that's big enough to sell to a Blackstone down the line, which necessitated doing it in a fund and doing it big rather than say taking a little bit of money here and there from different folks who are reaching out.
Do you actually get the economies? There's a couple
Mm-hmm.
routes I want to take the rest of it. But do you actually get those economies of scale, like in certain zip codes? Like which for your zip code that you have the most houses, how many would you say, or most homes, how many would you say are there?
It's a good question. Our biggest zip code, we've got 4 homes, but we tend to think of it more from like a vendor territory perspective. So like those 4 homes are within driving distance of another 20 homes that the HVAC vendor like can service all of them. So as long as we have enough homes like nearby the vendor where the vendor can service them all, then the pricing starts getting interesting. But that's just the maintenance side. Like our if Joe and Sally go to buy a house with a title company, like the title company is going to charge them 7 grand in fees. Like we can close on a home for about 1,100 bucks,
Hmm.
because there's SFR specific title companies now that didn't exist a decade ago. Like there's SFR specific insurance companies. Like our neighbors on the street and the houses are paying 1,800 bucks a year for insurance. We're paying around 1,200. Like those things start coming in, they start adding up, and it starts compounding really really quickly from an economies of scale perspective.
Sure. Are you guys looking at doing like a vertical integration play too, or each of these different regions have their own property management you work with?
So we have a property management partner. They're actually national, so they are the same partner across all of the homes. They're doing great. We're really happy with them. There is a question of at some point and scale, it probably makes sense to vertically integrate. Uh, One of our advisors is from Tricon, very operationally savvy guy, and he thinks that point is around 120 million worth of assets. Um, TBD on if that number's right, lower, higher, and if we pull the trigger on it. But it is something that we are thinking about, and there is a point where the cost benefit makes sense to do so.
Yeah, definitely. And then it's kind of cool because really you're telling your life story here, right? You're telling your life story on this, and finding out like at some point it just made sense to, if you're going to take dollars, like you're absolutely respectful. Number one
Mhm.
rule: don't lose other people's money, let alone your own.
Yep.
And so very careful about that too. And so uh, when you were, you said it made sense for it to be a fund, but like getting a fund and doing this is different than having the exit plan to sell to an institution. And so I'm kind of curious where that came from too, or was it just attached to a fund?
It's a good question. One, so like backing up a couple years, so when we first got started, one thing that we learned in the process of doing this with our own money is you really want to buy these homes like spring, early summer, because that's when the tenant base is moving in between the school years.
Mm.
And what came out from that is like that has kind of dictated our whole like fund schedule of like we raise money in the fall and the spring, we improve
Yeah.
operations, and then we buy them in the summer. Um, so when we first made the decision of like, okay, we're going to build a fund, we're going to build a fund and do this right,
Mhm.
it was like October. And we had to basically decide of like, are we going to go super fast and try to launch a fund from October to like next May in like a 6 month period?
Mhm.
Or are we going to do it right, go slow and go the next year and spend 18 months getting ready? And we decided the latter, but the implication that kind of came out from that is we had a lot of time of like focused of like, hey, like we're gonna need advisors. Like, let me call as many Wharton friends as I can
Mhm.
and get on the phone with as many Blackstone people as I can. Like, and through those conversations, you start realizing like, hey, there's an exit opportunity. This is what it looks like, and specific information like. Blackstone will not buy a home with solar panels. You could give them the home for $1. If it's got solar panels on it, they don't want it. Non-negotiable, like zero interest whatsoever. They will rip the solar panels off the house. It's like, okay, great. Like we are never going to buy a home with solar panels then. Like
Right.
that's super simple.
Sure.
But because we had 18 months to basically build this out, like find our vendors, we talked with like 14 different fund admin accounting firms. Like
Mhm.
it allowed us to get lots of different pieces of information and put it together to build it in a way that made sense.
Yeah.
And we were lucky because we had a couple of years of operating experience at that point already, where we could start folding in what we had learned with what we were getting in from all these different folks and vendors.
Yeah. Outstanding. And the operating experience, are you talking about operating from like BCG?
Operating our existing portfolio.
Okay. Got it. That operating experience. Cool. Yeah. So, I mean, the power of the network and just going to that and just really doing, I mean, again, like your consulting background is such a strong asset in this, right? Because you're just running that playbook all day long. Are there any other things that, like, I'm sort of curious. I don't know if anything comes to mind of this. So, it's kind of a risk here. There's if nothing we can skip. But what other skills do you were intentional that you kind of leverage from the consulting world to bringing this over to, building this business?
The I think this is going to sound ridiculous, but like a really big one is the mentality and approach of there's something to learn from everybody that you talk to, and like in consulting, like they teach you like be really nice to the executive assistant because they know more about what's going on in the business than the CEO does
100%.
that you're working for. So like they teach you to like you need to like go talk with everybody, and like some of the best most interesting conversations we've had has come from conversations with the postal worker in the area or the Uber driver or the UPS delivery
Yep.
person, because they know those areas better than anyone else does. And
Mhm.
uh, it's been a very kind of intentional thing for us of like when we're on the ground in the area, like I'm not. I go to City Hall. I talk to the local police department, for example. Like those ones, I think are gimmies. But
Yep.
like stopping the post office employee and talking with them for 20 minutes,
Yes.
exceptionally valuable.
Oh, yeah. They are the Google of the neighborhood. They know
Mm-hmm.
what's going on. Don't go there. That dog comes loose and will get you. Someone's stealing things. All the things. Yeah.
Yeah.
Good call, man. That's such an important one. It's like it's crazy, right? The difference between these quote unquote hard, tech skills and soft skills, but those types of things are just the by the way, the pro tips, the tips that make the difference, right? And one of the things I thought was really cool is I was checking out your LinkedIn. You were talking about how some of your LPs are. It was that some of your investors are actually investing for their children or something to that. Maybe you can help clarify that. Talk to me about that, and we'll roll into a little more about like who would be good investors.
For sure. So on our LP side, we have a really high concentration of investors that either have kids themselves and are thinking about like going to a good school district. They've already made that move, or they themselves were the kids who were in a really good school district and it got them to a good school, and now they're working at Amazon or something along those lines. Um, but the implication from that is like we have a lot of investors who've got kids who are 2 through 7, and they say, hey, I don't love 529 plans for a variety of reasons. I'm going to give you guys 200 grand. This is the money I'm going to use for my kids' college fund when you guys sell, or I'm going to pull it out, or whatever it might be, when they go to college in a decade. And it's kind of like a full circle thing of like investing in education focused real estate that will eventually go to higher education to pay for their kids' college.
Got it. So, uh, interesting you used the, investing for the decade. So how are you guys structured your fund then? Is it, 10-year hold times?
So we're an evergreen fund, so we could theoretically last forever. Our rough thought process is we're going to sell the portfolio if somebody overpays for it. And we think that's going to happen somewhere between year 7 to year 12. And we've structured it in a way where if you do like a closed end 10-year fund, like at 10 years you're selling, or you can
Yep.
get like a 1-year extension, which really means like you have an additional 3 months because it takes a while to sell the portfolio. Um, we didn't love that because it gets rid of our optionality, and like the buyers know that. So like we wanted to structure it where if it's a good price, if it's an overpay number that we and our LPs think is a good number, we'll take it. And if it doesn't, like the portfolio is profitable, it's cash flows, we're paying out distributions. Like we're just going to keep paying out distributions until it makes sense to take a number to sell it.
Okay, so a couple things. Break down what that evergreen fund is, and then
Mm-hmm.
talk about what that means if someone's listening and they're like, Sean, sounds great. I have kids. I understand what you're saying. I have also looked into 529 plans and other things, but I
Mm-hmm.
think I'm interested in placing 100K with you. When do I get my first dollar? How often do I get my dollars? What does this look like in 5 years? Or what are my options?
For sure. So because we're an evergreen fund, and this is not a perfect analogy, but it's like close enough. We almost function as like a not publicly traded REIT. So if an investor joins in the fund right now, they are buying into the existing fund. So they'll own a little piece of all of the existing homes that we already own, and as such are immediately entitled to the cash flow that's coming off of them. So we pay out distributions monthly. It's the third Friday of every month. We send out distributions out to the investors. So theoretically, like if somebody joins the first of the month, they get distributions 3 weeks later as they join into the fund. That's the distributions, which is kind of like the dividend
Hmm.
dividend equivalent. We use their investment to go off and buy more houses. Um, and those houses throw off depreciation. We do pass the depreciation via cost segregation back to the investors on the K1. Um, so everyone's tax situation is different, but for most of our investors, it means their distributions are not taxable. And then the last piece is the underlying equity, because it's like a non-publicly traded REIT. Like because you're buying in, your distributions are your dividend, but the value of your stock is still goes up theoretically as homes appreciate, as we pay down mortgages, and homes get more valuable. So investors can decide to withdraw from the fund early after a lockup period and get the value of their stock back then, or they can wait with us, keep clipping the distributions, and then on the sale of the portfolio, theoretically get a bigger check from the sale of that equity at the end of the day.
Got it. Lockup periods.
Yep. So we have a 5-year lockup period, meaning when someone comes in, they're in for a minimum of 5 years. Um, Ideally, we would love to do sooner. The challenge with it is because we do 3-year leases with our tenants. If somebody says, "Hey, I want my money back," 6 months in, and we just bought a house and put a tenant in there for 3 years, like we don't really have a lot of flexibility right there to pull their money out because there's a tenant living in the house that their money paid for. So we need the 5-year lockup period as a result.
Yeah, makes sense. I just wanted to like the reasoning, the why makes a ton of sense there,
Mm-hmm.
because the capital is at work that they've invested. Um,
Mm-hmm.
so, is there any plan or is there any reason why you would sell a home?
Uh, Theoretically, there's a couple scenarios where it would make sense to do so. Um, One that's like long tail, but mathematically inevitable to happen over the life of the portfolio is if we have a home burned down. We don't
Mm,
want it to happen. We don't want anybody to get hurt. But because we're in really good school districts that don't have buildable land left, there's a strong, and some of these zip codes don't put up a lot of red tape for people to buy old homes, knock them down, and build up a big
Yep.
mansion. There is a mathematical argument that is pretty strong, actually, that we would actually get more money if we sold the lot than if we were to rebuild the home with the insurance proceeds on it. So like that is probably going to happen. Um, I outside of that, ideally we won't sell homes because the value of the portfolio gets bigger the more homes we have in the portfolio. So if we're pruning out homes, we're hurting our abilities to basically grow the fund into a size that makes sense that somebody would want to buy it as a portfolio.
Yeah, that sale that you were just talking about is one that I was thinking about because I've seen that multiple times in Seattle and definitely
Mm,
seen it times in Austin. And so I'm like, okay, I see that as a potential one, especially for some of the older neighborhoods that are based around high schools that do well. So yeah, kind of a curious one there. Um, what do you say about people that may not know that like the appeal of the business model, understand it, especially what you're talking about from the investment perspective? But I got to throw this out here because it's top of mind. I talked about it twice with some of my investors today. But it's like, okay, well, Sean, like, well, how does this make sense? I mean, interest rates, right? Like, how do you consider this when you're going into buying these houses? Like, yeah, it makes sense. Like, you've got deal flow because you work with all these realtors, they control the majority, but like, how do you think about these? At least, how do you think about it when you're doing a deal?
for sure. So on the interest rate side of things, we try our absolute hardest to be a not very debt focused business. So like at its
Mm,
core, like if you think about like a risk reward scale, like 10 out of 10 being highest reward and highest risk, like we are trying to be a 6 out of 10 on the on the reward scale and like a 3 out of 10 on the risk. Um, so like slightly better than average reward and like lower than average risk. And for that like we use 30-year term debt. Like we are at 59% LTV in the fund. We're going to drop it down closer to 50. So we don't use debt a ton, and we only use it where it makes sense to do so from an economic perspective. So like we close in cash on homes, and then refinance that onto a portfolio loan. We're only going to do that if it makes sense to economic sense to put those
yep.
homes on the debt. Like otherwise, we'll just keep them on in cash. Like they're clipping a pretty solid coupon. We'll just keep sending out that coupon, and we can wait until the time where it makes sense to put them on debt. Um, I I saw this stat actually back at school that basically said if you go back to 2008, 2009 and looked at all of the real estate funds that went belly up and all of the real estate fund syndications that went belly up, something like 93% of them, it was like low 90s, was because they had too much debt or debt that came due in the middle of 2008, 2009, they couldn't refinance it.
Yep.
And like for us, it's like, okay, that is a flashing sign. Like that is the biggest unforced error we could make, is putting ourselves in the hands of debt. So like, we're not going to do it.
Yeah. Yeah. Good call. And you probably get much better terms on that portfolio loan anyway. And a much, if nothing else, a lot better of a relationship with, I would imagine, better relationship with whoever is doing that portfolio loan for you too.
Yeah. I mean, at its core, like we're, and every type of real estate is different. Like we're not repositioning apartments. We're not developing apartments. Like you need to use debt in those businesses. You need to use more aggressive debt in those businesses. But like we're buying like already really good homes in like A plus 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 locations. So it's like we don't need to do anything super crazy. And even if we did, like even if we slapped down like aggressive floating rate debt on our homes, like single family homes are not, if you're doing any renovation, are not really like value add monsters that you're going to
Hmm.
see. Like we're trying to be like the whole spectrum of like stocks. We're trying to be like AT&T stock, like steady Eddie, heavy dividends. Like that's the plan. Like we're not trying to be like a FANG stock, for example, that's gonna shoot up high.
So, as you're thinking of, I understand this is a big question, and this is one that it's up to everyone's own decision making. But if you
Mhm.
had any general first principles guidance around this when people are looking at, what you're talking about is, thinking about a portfolio, right? People
Mhm.
might be investing in stocks, but they're thinking about real estate. Um, Maybe how if they're thinking, all right, well, I got a Sean, sounds interesting. I
Mhm.
got a bunch of cash in stocks right now, but I am interested in going to real estate. How much should I theoretically be looking to invest over the next couple of years of my portfolio in some kind of percentage basis?
Good question. I think it depends on what you're looking for in real estate. Like for example, on if you're interested in putting money into like development deals or like reposition deals, like those are more like angel investments. They're safer than angel investments, but like directionally, that's right. Of like,
Opportunistic, yeah.
yeah, like if you put money into a development deal, it's a hole in the ground and it's going to be a skyscraper one day. Like that deal is going to triple your money in 3 years or it's going to go to zero. Like it's pretty binary in terms of like what a development deal is going to be. If you're putting money into like boring single family homes in long-term school districts, or like you're putting money into a fund that owns a lot of like triple net lease Starbucks, Seattle
Hmm.
shout out there. Like it's a very different kind of risk reward profile. So like, at least for me personally, like if my brother came to me and was like, hey, I'm thinking about real estate, like what should I do? Like that would be my first question to him of like, hey, real estate's multi-trillion-dollar asset class. Like, are you thinking development? Are you thinking like boring steady Eddie? And
Hmm.
then from there would be like, hey, like if you're thinking higher risk, higher reward, like I would skew lower on the percentage. If you're thinking more like steady Eddie boring, like buy a bunch of triple net lease Starbuckses or homes of good school districts, like maybe a touch higher because it's more of like steady Eddie. It also depends too on like age. Like my brother's younger than me. Like I would probably tell him to skew higher risk. I would probably tell him to go look at development deals because he's younger. If someone's older or they're putting like their kid's college fund or like their retirement money into something, like I would probably tell them to go a little bit more steady Eddie.
Cool. And that makes a lot of sense too, right? Because we were just talking about the perspectives of if they're investing with you and they're looking at from their payout for their kids, then you want to make sure that the returns are going to be there. You want to make sure that you have something that's a lot safer on that risk profile where you're not, 3 to 5 years of it could triple your money or not, right?
Yep.
Um, not sure you want to uh, that might be the play for your portfolio when you're thinking about your kid's college fund.
Yeah,
So, uh,
exactly.
is a way to put it. Now, one of the topics I know it's important to you is putting your money where your mouth is, right?
Mm,
And so, talk to me about that. Like you talked about you're having kids too. We obviously talked about your origin story here and how
mm,
you guys, your wife put together this and the first couple ones and the fund, et cetera.
mm.
But you're continue to invest in this as well. Uh, Tell me about that, and then I have some kind of rapid fire ones, and then we'll close out.
Okay, cool, for sure. So this is total soapboxy. I apologize in advance.
Go for it.
Um, but there's a metric that people use a lot, which is GP co-invest, which is like what percent of the deal is the GP's own money. So like make the math easy. It's $1 million deal. The GP puts in 100 grand. They have a 10% co-invest,
Mhm.
and that's generally perceived to be like pretty good. Like the higher the co-invest, like the safer the deal is quote unquote perceived to
More
be.
skin in the game, right?
Exactly. I think it is the absolute worst metric of all time. I strongly disagree with the concept of it. And the reason why is because it doesn't actually consider the GP's own, call it, financial picture. For example, we're talking Amazon. Like Jeff Bezos could launch a real estate fund tomorrow. It could be a $10 million fund and he puts in $2 million of that. His co-invest is 20%. It looks like a really good deal. Jeff Bezos does not care about that $2 million. He will forget about it tomorrow.
Sure.
It's it, so it's like it doesn't actually show the like level of care. I think the metric that actually matters is what percent of the GP's net worth is in the deal. are in the fund.
Sure.
Because if it's like, okay, Jeff Bezos launched a fund and he put in 70% of his money, like he's going to think about that when he's going to sleep. He's going to think about that while he's brushing his teeth in the morning. He's going to think about that driving into the office. Like that is going to be top of mind for him.
Yeah.
While the 20% co-invest actually isn't that big of a deal. So that's my soapbox rant. And it's the first thing I tell people when they're like, oh, I'm like evaluating a deal. I always tell them like the question to ask is like, ask the GP what percent of their net worth is in the fund.
I will clip that for you, Sean. Awesome. So the takeaways there is there's more than 10% of your own net worth in the fund, and that's why you care about it a lot more.
That's right. I mean, like me personally, like I've got just about 80% in the fund. Like this matters to me. Like I need the
Got it.
fund to work. But like that metric I think is lost because a lot of LPs ask like, hey, like what's the co-invest? And I'm like, okay, like the co-invest is 15%. They're like, oh, that sounds good, but it's missing actually the color of like, hey, no,
Yeah.
like it really matters.
Got it. You know, you're obviously really sharp, and I love
Thanks.
the leveraging of consulting. I so love the consulting thing because I don't have enough time for this, but I think it's it's so important, especially the tips of talking to the male people, talking to everyone, and not only just genuine kindness, but getting into it and improving the neighborhoods, which means being nice too. In
Mm-hmm.
addition, it's you're building this company while you're really building family, and you're thinking of many other families around high schools too. And so,
Mm-hmm.
how are you thinking about types of values that you want to teach your kids? How are you thinking about, um, you know, uh, you know, you're thinking about families that are taking their kids to school in these critical years 12, 13, 14, 15. Like, how do you think about teaching values to your children as well, especially when it comes to a financial aspect?
Yeah. I so the way I've talked about it with my kids, and my kids are young. My eldest is soon to be 5 and starting school himself. Um, but I talk about it this way with him, and I've actually made it our number one value at Scholastic. Like, so I talk about it with our team here as well. Um, but it's the way that has conceptually made sense to him is protect our investors' years. So like our minimum investment is 250 grand. Like that takes the average person like years of their life to save that much money.
Hmm.
If we were to do something silly and lose someone's 250 grand, in practice that means we lost them years of their lives that they spent saving that much money. Like maybe that was 2 years worth of bonuses, for example. Like that's shot, that's gone because we did something silly with their money. And that has resonated with my 5-year-old because he doesn't understand the concept like how much money is what, but he understands it from a time perspective. It's like, wow, like I was really young 2 years ago. 2 years ago is a long time ago,
Hmm.
and I think that has resonated. I think the other thing that have really tried to do with them, and I took them to their gymnastics class earlier today. Actually, we talked about it. Is I try to reward effort, not outcome. So like they're getting pretty good at this one thing at gymnastics, and it's not, oh, you're so good at that. It's like, oh, you practice really hard, and practice is what makes you made you good at it. Because if I can teach them effort, then they'll do great in whatever they want to do in their lives. If I teach them to think that they're super smart and they're super good at things and it's just naturally going to come to them, then they'll miss that effort piece that I think is a real important element to have.
Yeah, outstanding. And that is important because in some cases, like you're saying, you can try really hard, you may not get that outcome. But if you keep trying hard and you find new ways to get that outcome, you'll always have that momentum.
Mhm.
Are there other core values around Scholastic that and how you guys do things?
There's a bunch. There's a lot. So we have 6 total. I'll give you a couple of them. One is we're relentlessly resourceful. Like if there's a problem, like we don't say, oh, I don't know what to do. Like we keep working the problem until we figure it
Hmm.
out. Um, We have another one. It's my favorite. It's intentionally crass, so I'll use the PG version for it. But the value is seniority is BS,
Mm-hmm.
and the importance there is I do not want this ever to be a place where like the person who's been here longest or the loudest voice in the room is the one who's making the decisions. Our newest employee, we had somebody who started yesterday. Like
Nice.
he has already chimed in and been like, "Hey, this thing that you're doing here, I don't think that makes sense, and here's why." And like that's what we look for. We look for smart people who are willing to speak up, and we want to make sure we're a place that rewards that. And then the last one is, and I stole this from a buddy of mine, but slow is smooth, smooth is fast.
100%.
um, Want to make sure we're doing it right, and like frantic, like freaking out, trying to grow super. Like, that's not right. Like we want to make sure we're doing it smooth, steady, and that's where growth comes from.
Cool, man. Sean, it's been a pleasure, dude. Tell people where they can find you. I'll make sure it's all in the show notes too, but let's make sure people get connected with you.
Yeah, I appreciate that. We're at scholasticcapital.com, and then I'm actually surprisingly, I'm still surprised me that I'm going to say this, but I'm surprisingly active on Twitter. I tend to just like tweet stream of conscious thoughts of like what we're seeing and what we're doing and what we're thinking about on a day-to-day basis, and have had a lot of fun meeting some really awesome folks doing that.
Sweet, man. Anything else you want to mention before we wrap up?
Nothing top of mind. It's been fun. I appreciate you having me.
Outstanding. All right, take it easy. Thanks for joining us on another episode of Path to Passive. We love connecting with our listeners and those on the path to architecting their wealth and improving their lives. Feel free to let us know what topics you'd like to see in future episodes. Get in touch with us through email or Instagram. See you next week for a new episode.